Welcome to Fear and Greed Summer Investing Series, brought to you by Vanta, specialists in compliance-led growth. I'm Sean Aylmer. Investors looking to diversify their portfolios may well be looking to global markets. So where does China fit into this? As always, this is general information only, and you should seek independent advice before making investment decisions. William Liu is a senior investment analyst at Wilson Asset Management. William, welcome back to Fear and Greed.
Hey, Sean.
You've been in China recently. I remember when we spoke last year at one point, you were about to head over there. What's your overall impression of the Chinese economy at the moment?
Yes, the Chinese economy continues to remain weak. As you said, I was in China in November, and the sense on the ground is some of the most recurring conversations I had were consumption downgrade. Clearly, people were watching what they were spending on, prioritizing what their wallets are going towards. So despite some of the announcements that we've seen towards the end of the year of coordinated fiscal stimulus, we think that's largely going to be a 2025 story. The government signaled more public borrowing and more focus on policy to focus on consumption, but we're yet to really see the signs of that. So feedback on the ground was that we saw a continuation of the macroeconomic conditions. We saw a little bit of bump during Golden Week in October, as consumers had a little bit of hope that maybe the fiscal stimulus measures could work, and they had some coupons on white goods, etc. But it continues to be weak, and that's evidenced in some of the more recent data. With this retail sales growth is only growing 3% year on year in November, which is lower than the 5% expected. And then at the same time, industrial production is doing okay. Like that's growing roughly just above 5% year on year. So it's leading to a little bit of an overcapacity issue, which isn't helping with the US-China tariffs that are potentially on the horizon as well. Trump talking about blanket 60% tariffs. So like as a team, we have minimal exposure to China. We're closely observing what's happening on the ground. We still need to see some signs of stabilizing property prices, which we kind of are seeing because property prices fell at its slowest rate in November. It's still not positive, but arguably less negative.
Less bad.
Exactly. And we still need to see signs of the property market stabilizing. We think China can improve just given its low base, low expectations. We do think there'll be fiscal stimulus measures in 2025, but we're expecting a modest improvement. We're not really expecting a dramatic acceleration, which I think some investors were hoping for when the announcement of fiscal stimulus measures came up.
So if you're an Australian that wants to invest in China, if for no other reason than diversification, how should you think about getting into China at the moment?
Yeah, it's a really good question. You can buy China shares, like H shares in Hong Kong, as a direct way. The other way, like the way we've been looking at China is a lot of Western brands have Chinese exposure as well. So a company, say Nike, which we don't own, but a portion of their revenues come from China. So there's multiple ways to play, whether from directly investing in Chinese equities, but also in Western companies which might have Chinese revenue exposure.
What's your big fear about China then? So if I decide I'm going to buy Nike, I'm going to buy BHP out of Australia, that makes an easy one. But I mean, what is the fear? Is it that China actually, the growth rate doesn't pick up like we hope it will?
Yeah, I think the fear is like the playbook in China's changed. So before you could buy BHP and Rio on iron ore exposure because China would stimulate. They would try and reflate property prices, invest in infrastructure. So the iron ore miners and the commodities were big beneficiaries. This time it feels a little bit different because they're trying to deflate the property bubble. And so we think the winners coming on the other side will probably be consumption-based companies. But then also the market environment's changed. So Western brands previously enjoyed halo effects in China. So Starbucks, McDonald's, Nike, they were seen as amazing brands, really high quality, but the Chinese competition has largely caught up. So I was really surprised at the amount of innovation there, and there's a real value proposition. So maybe they're not as good as the top tier performing products, but they understand the local market. They've got the manufacturing local for local, and they're selling it at an affordable price. So Chinese consumers are in an environment where consumers are becoming increasingly savvy. We're starting to see some of those local Chinese brands do quite well, actually.
Interesting. William, thank you for your time.
Thanks, Sean.
That was William Liu, Senior Investment Analyst at WAM Global. Remember to get your own independent advice before making investment decisions. This is Fear and Greed Summer Investing Series brought to you by Vanta. Vanta automates compliance for frameworks like ISO 27001, SOC 2, CPS 234 and Essential 8, saving time and money while building trust. Join over 8,000 companies like Atlassian, Dovetail and FireAnt managing real-time risk. Get $1,000 off at vanta.com/fearandgreed. I'm Sean Aylmer. Enjoy your day.